Edmund, I talked with him a couple of weeks ago. We did an intro call after he was on the Friday meetup that I host, and I was so impressed with what he had to say that I had to book him for this meetup. But Edmunds, so one thing about him that's near and dear to my heart, he's military, Canadian military, but we're allies with Canada, so that's awesome. Spent several years in the Canadian Special Forces. Then he started working in essentially the Canadian commercial real estate space. And I want to say he raised about $70 million over the period of 10 years, with an asterisk that $70 million was Canadian dollars. But he did me a favor and converted it, and we're about $55 million US is what he raised for commercial real estate. And right now, what he says is he's managing his own family office, which is probably where we all want to get to. But what he's going to talk to us about today is how to find those accredited investors. And just before I bring him on, why is it important to have accredited investors? Well, the SEC cares. Accredited investors, people with a net worth of $1 million or more. There's lots of different ways. That's the main one. Or an income of over $200,000 per year makes you an accredited investor, which allows you a certain standing with the SEC for investing in private placements. Not going to go into that any more than that today, but that said, Edmund, super excited to have you today. Welcome and thanks.
Yeah, thanks for having me. Just to clarify a couple of points so I don't get in trouble, I wouldn't necessarily classify myself as special forces. I was airborne infantry, so I kind of say elite forces, but not quite special forces because they're airborne brethren. So, and then I remustered after infantry into combat medicine. So I was a combat medic as well.
All right. Okay. Good distinction there. And fellow military guys appreciate that. So it's kind of funny. There was a while where I ran into a string of people every time I met a military vet that always claimed to be special forces. And then you start talking to them and you're like, wait a sec, you don't sound like special forces. But I'm glad to have the opposite end here where no, wait, not me. But so that said, Edmund, why don't you start out by telling us a little bit about yourself, what, where you came from and, what turned you into where you are right now. Or who you are right now.
Yeah, so I'm from Toronto, where it's probably it's kind of like the Canadian equivalent of like New York City. Mm-hmm. So high concentration. This is where finance originates in for our country. It's most of the finance of the world or of the country is managed in Toronto. So we have Bay Street, it's our version of Wall Street. And when I first started out in financial services, so I was a private equity guy for about 10 years. As a licensed stockbroker as well. So I managed money all for high net worth clients. So day one, when I got into finance, I was working exclusively with accredited investors, mostly all in private equity real estate. And one of the things that I discovered, like when I originally set out, I know a lot of people have read Rich Dad, Poor Dad. So did I when I was younger. And I set out, you know what, I want to own cash flowing investments. And I had determined that real estate was the best way to do it. I was about to handle my first deal when I was in my 20s. I was kind of nervous and a little bit reluctant. And then I discovered this private equity firm that was managing real estate. And I said, this is a great place to learn just before to learn how to asset manage. And as I started to get in there, I basically caught a break and I spent about 10 years there, built up that significant portfolio. And I recognized in that time, I'm more of an extrovert and I can do the analysis and I can do all the technicals. I can do pro formas. I just hate it. I hate doing it, but I can explain it and I have a working knowledge of asset management. I just realized that my skill set is more for raising capital, client facing, and that's what I ended up doing for about 15 years. So that's kind of what I specialize in. So I specialize in accredited investors and raising capital from accredited investors.
Nice. And it's something you said that I think it's an important distinction. I think no matter what aspect you're doing, I mean, real estate's a team sport, or at least multifamily is a team sport. It's good to have a good foundation on both sides. If you're a capital raiser, being able to understand the analysis part is definitely very helpful, and vice versa. If you're the analyst, understanding the capital raising part is extremely helpful. So you hopped into, you started working private equity firm. tell us about that, what you did there, and let's go from there.
Yeah, and I've been talking to a couple of people on your calls, and a couple of people in the U.S. here, and I realized that a lot of them are asset managers. And what our firm, we started to get to about half a billion, so about 400 million US. And one of the things that we realized is that as we started to get bigger, we had really two sides of the house. We had one side, which was asset management, which included property management, all that other stuff. And then we had all the client facing side. So I really specialized in the client facing side. And I recognized that, and one of the things that I advise as people are building their syndications is take a look at where you have a default advantage in. So one of the things that I do, like today, I'm retired, as you mentioned, and I'm a business coach. So I'm a sales and business coach for entrepreneurs, and also, I guess, for financial professionals is what I can do. So one of the things I do is I tell people, start off with doing an MBTI test, right? So Myers-Briggs type indicator. If you haven't done one recently, you can just Google it, and you just Google MBTI free test. It'll take you to 16 personalities, I think .com or something like that. Take the test. And then the first thing you want to figure out is, where do I have a competitive advantage? Am I more of an introvert, an extrovert? Am I more analytical? Or, do I really like being out in life of the party? And try to work in an area or pick a side where you're going to have an advantage. For me, I recognize my advantage is I love being in front of people. I love talking to investors. I love explaining deals to them and trying to, but for my personality, I really hate structuring the deals. I really hate going through the weeds and creating pro formas and looking at rent rolls and cap rates, all that type of stuff. I know how it works. I just don't really want to spend all my day going through Excel spreadsheets. But for me, I would rather be at a networking event. I would love doing that. My wife is the opposite. My wife is also in financial services, but she's an introvert. She's great client facing, but it drains her, right? If she's doing it all day long, at the end of the day, she just needs to, to recharge. For me, I'm the opposite. The more I'm in front of people, the more energized I get. So that gives me a competitive advantage when it gets to raising capital, because when you start to get a really sophisticated syndicated group or a company, and you start getting into the 400, a half a billion, you've really got to be on your A game. You've got to be fully immersed in what you're doing, whether it's going to be on the asset management side or at the client facing side. It's like pro sports. Make sure you're on the right team. Like you're either on defense or offense.
Yeah, and I agree. I agree 100%. Incidentally, what is your Myers-Briggs personality type?
I'm ENFJ.
ENFJ. I am INTJ, but my I and my J could go either way depending on what day it is. I'm very close to an ENTP as well, but two of those I'm right in the middle of. So just curious about that. But just want to just highlight one of the things he said. Everybody's got a competitive advantage somewhere. This business takes a lot of different personality types, a lot of different skills, and he talks specifically about personality, but also look at skill sets as well. And access, there's a lot of things that you may have a competitive advantage. If you live in Austin versus, Fargo, North Dakota, no offense to Fargo guys, you have a competitive advantage just by where you live, because it's a hot real estate market. So, I'm going to take that one step further. Don't just look at personality, which is important, but look at, every other thing that you have that could put you at an advantage when you're starting out. So yeah, so you like back to you, Edmund, you like the more social side, you're more extroverted, you like, being with people, talking with people. So you focused on the client side of the relationship, right?
Yeah. And to continue on that point a little, it's not to say that if you're an introvert, you can't be a capital raiser. I know a lot of introverts that are capital raisers. It's just that it's going to take more effort than it would somebody like me. So I'm already like 100 meters ahead of you at the beginning of the day. And at the end of the day, I don't need to recharge. Right. But for you, if you're an introvert, you may have to do that. So just recognize that it's just like, if you're Michael Phelps, then you recognize, I have a competitive advantage when I drop into the water, but I don't have an advantage if I start running. So why try to force and work 10 times as hard trying to be a marathon runner when I recognize if I just go into the water, I'll win gold medals. So why don't you do that? Try to figure out where you have that advantage. And like you said, there's a lot of different personality types that is needed in a well-rounded syndication deal, right? So all the professionals in a syndicated deal, you can have a spot anywhere.
Yeah. Absolutely crucial. Now, something that a lot of people have talked about is, link yourself up. Now, obviously understand what your competitive advantage is, but if there's an area that you're typically bad at, that's where you find partners in a lot of cases. So find a partner. And, the military guy and me and Edmund's going to understand this. When you look at machine gun fire, you always look for interlocking fields of fire, so people have, left and right lateral limits, and they're looking down the range. And I've got a couple military guys with smiles on my face and a couple non-military people going, what? But you're looking for those interlocking fields of fire. You want overlap. It's like, a better analogy, when you're painting, you want to make sure that, or vacuuming, make sure that, one line, crosses over on the other and overlaps a little bit. But anyway, sorry for that, little, outside the lines there. But anyway, so good enough. So let's talk a little bit. Tell us a little bit about the types of deals, real estate deals that you would do, or that you would raise money for.
Yeah, a typical deal that we would do is anywhere between a $5 to $10 million raise up. And my view is that you don't necessarily want to get bigger than that, because it starts becoming a little problematic. You don't want to have multiple properties in one deal. It's better to have like one property in a single deal or a single LLC. We focus primarily, and this was through the 2000s. So about 2001, 2011 is where I was really focused a lot on it. And most of the properties that we were doing were in Dallas, Fort Worth. So I'm a pretty big specialist in DFW property in that period of time. A lot of it had come out of the savings and loan crisis from the late 80s and early 90s. And then we got picked up some property from the S&L crisis. And then we start to develop those and start to build those. But from day one, I think my specialty, as I mentioned, was raising capital from accredited investors. So in the US, it would be just becoming a 506C specialist from the beginning. So a number of people that I've talked to have been a little nervous about going immediately into 506C on their first syndicated deal. I'm hearing a lot of discussion about people saying, well, I want to sort of cut my teeth on a 506B, working with friends and family, getting a little comfortable with it first, and then jumping straight into, or then, graduating to a 506C. I think my advice is, when I first started out, I did 100% accredited investor from day one. And I recognize that in financial services, if you start off with a B, and here's where the downside can be, is that if you start with a 506B, it's going to take you a little while to raise that capital. It's going to be harder. It's a completely different skill set from raising capital from an accredited investor. You might think it's the same, but it's not a prerequisite. And I'll explain why. Part of it's kind of like learning how to play checkers before you play chess. It uses the same board, but it's a completely different set of rules. The first part is the skill set needed for mass affluent. It's, if you're going to ask, you have minimums. Your minimum is probably 25 to 50,000. 25 to 50,000 for a non-accredited investor, mass affluent, is going to represent a larger percentage of their net worth than it would be for an accredited investor, which means that you have more fiduciary responsibility. And that means that they're going to be on your case. They need more client relationship. And more client relationship and more hand-holding means more cost for you, because you have to pay somebody, or it takes your time to get those checks. And you're going to it's going to take you more time to collect checks at 25 or 50,000 than collecting checks at 100 to $1 million at a time. So I'd rather spend less time in client relationship, more time just raising capital from lump sums, and then it represents less of somebody's net worth. So you're not talking to that client all the time, explaining every nuance of the deal, right? So it becomes easier. In my view, starting with 506C, it's easier than doing it with 506B. You're gonna be spinning your wheels, and then once you do raise your capital and you realize, I don't want to be in a B, I eventually want to create a syndicated organization or firm that does syndicated deals in a C. Well, it's going to take you a little while to offload those B clients gently without offending them, right? So you're going to be stuck for at least a 5-year hiatus, in my view.
Yeah, there's a lot of good points there. I don't think I ever considered going straight to C. I think a lot of people, what you talked about sounds like what a lot of people do with single family to multifamily. They start out, getting a couple of houses here, a couple of houses there, not thinking they can make the jump without hitting the single family rental check in the box first. And it sounds like you're saying it's the same way, which is interesting. But just to double down on what he said, looking at our investments, we've raised $10 million over the last just two and a half years. Our average non-accredited investor has put in the minimum amount, and it's It's almost every time. I say, without numbers in front of me, about 90% of our non-accredited investors are putting in the minimum amounts. And most of our accredited investors will put in the minimum amount the first time, and then after that, you're getting six-figure checks from a lot of people. So a lot of good reasons, just kind of doubling down on what he said, a lot of good reasons there. It may take you a little longer to find the people, a little long. It's a whole different marketing scheme, which I hope we can go in today. And it's going to be out of my comfort zone. So I'm going to be letting Edmund talk the whole time. So kick it back to you, Edmund. So let's say we're beginning and we're starting this 506c. How do we do that without, I mean, none of my friends, none of my family are accredited investors. So I can't tap into that network because it's a 506c. How do I find the accredited investors?
Just to continue on a little bit on that point, just to move over, one of the other downsides of a 506b is that the SEC regulations, you can get into trouble. And keep in mind, I had been investing money through the 2008. So I made those calls in 2008. A lot of things went sideways, if not like completely blew up. And making those calls can be brutal. And your client relationship or your client attitude can turn on a dime. And your clients can actually start complaining, and they'll complain to everybody. They'll complain to the regulators and all that, right? So if they can come in and they say, well, I never really knew Ed. He said he's supposed to be friends and family. There was no pre-existing relationship. I technically didn't qualify for this investment. I should get my money back, right? And now you've got all the scrutiny, and you can get into trouble with that. But if you start and you classify, no, I'm a C. I'm a 506C. I can now open myself up to the general public. Then I'm completely free. So I'm not, there's less regulatory scrutiny to say that I don't have to prove that I have a pre-existing relationship. All I had to do is prove that I exhausted the appropriate amount of attention to verify that this person was accredited, right? Ask for a couple of bank statements or something like that. So it's a little bit easier. So how do you break into, and how do I debunk or demystify the accredited investor? Well, the first thing I would say is if you've never done it before, there's different levels of accredited investors. There's different levels of millionaires in a couple of different slices. The first slice is the people that I would classify as newly accredited or don't realize they're accredited. So somebody who just maybe hit 200,000 for the second time and they didn't realize there's such thing as an accredited investor. Or somebody's like a year ago, they were like 990,000. The DJIA just went up 10 points and now all the congratulations, you're an accredited investor. And they didn't know, right? So they're not all that financially sophisticated. You're kind of doing a little bit of coaching. That's where I would start. So it's about the newly accredited to about maybe 1.2, $1.5 million person, right? That's where I would start. And you'd be a little bit more comfortable with those types of individuals because they don't really know a lot about investing. They're probably earlier on in their career, maybe an older millennial, maybe an ex-gen. They're maybe a lawyer or an accountant, something like that. And you start to educate them and show them about, hey, let me show you something better about your 401k. Because they're probably spilling out of their 401k or their IRA, right? They don't have enough space anymore. Now they're looking for something else that goes beyond that. And that's typically what I would start to look for. So one of the things that I do is people have been asking like, well, how do you prospect for an accredited investor? Well, there's a couple of key things I'm looking for when I have a discussion with somebody, say at a networking event or I'm at a wedding or some kind of social event. Some of the cues I'm looking for is I'll drop little things like 401k or IRA. And if I hear a response like, oh yeah, I've maxed out my 401k and now I'm looking for other alternatives. If somebody says something like that, it's like, okay, I know that this person first probably has a tax problem, recognizes they have a W-2 tax problem, and they've utilized all this stuff and they've maxed it out. Now they're looking for an alternative. That's great. If somebody says, oh yeah, I got all this room in my 401k, or I never max it out, or I don't even believe in a 401k, then, chances are that the person's probably not accredited, but, that's not normal accredited speak. If I start going into a little bit further, one of the things that I've explained to a couple of people is that when you're selling syndicated deals, there's 3 sales you got to do or at least verify for somebody. The first sale you got to do is why real estate. So there's so many people out there that, and I'm talking about, get real estate over GameStop or real estate over, investing in stocks or bonds, all those types of things. You got to explain cash flow investing, right? That's the first one. So if they don't understand real estate investing, then that's the first sell you got to do. The second sell you got to do is why syndicated deals over just going and flipping property or going and buying my own multi-family home. After syndicated deals, the last sell you got to do is why me out of all the other syndicators out there. So those are the three. And then once you've broken those three, now you got yourself a client.
Nice. So why real estate? Why syndications? And why me? So I like that. I mean, so
Yeah.
a lot of the people that I talk to, there are a lot of people who invested. Fortunately, a lot of them have already made the decision on real estate and syndications. But I mean, you're out on the hunt looking for these accredited investors. And so the first hump you got to get over is convince them that real estate is worth investing in. Second hump you got to get over is now that you've convinced them on real estate, now you got to convince them that a syndication is a good way to go. Bring that passive investment, passive income, and then finally, you got to make sure they trust you to do it as well. I like that. How do you typically go about this? Is this one conversation, several conversations? Is this a whole process? What's a typical way to get people over these three sales?
Well, I think before you get into that,
Mm-hmm.
that we got to segment a little bit more on going back into your mindset. So when you're going to go out and find an accredited investor, it's not just in these slices. So first off, we got into newly accrediteds, and then the next level we get to is like a $2.5 million accredited investor. In that mindset, it's understanding your prospect's mindset. The mindset of somebody at 2.5 to 5 million, they've probably started to get into real estate or alternative investments, structured products, little things like that. They probably have a stockbroker or something, or an investment advisor. You may or may not be speaking to them. You might be starting to speak to their accountant, their tax accountant. And then if you go beyond 5 million, so the 5 to the 10 million, they definitely will have a tax accountant. They'll probably have a tax lawyer or a state lawyer. And they definitely have an investment advisor. And you have to recognize that you're going to be starting to become one of those individuals that will talk to those other professionals in that room. Now, when you get to 10 million plus, you will have those professionals, plus you may also have a quarterback that handles all the other people, all the other financial people, which is like normally like a family office. So somebody managing the family office that manages all those other professionals. And then you get like the 100 million plus, which is, you might as well be trying to raise capital from institutional money pension funds, right? So they'll have like a team of people. So those are sort of the ranges that you want to get into. That's one way of slicing accredited investors. The next way is getting into their mindset of what is their background and culture. So the highest concentration of millionaires in the United States is in the state of California. There's over 1.1 million accredited investors there. The second highest is Texas. So Texas, I think, is like 640 million accredited investors. And what I explain to people is that you got to understand that if you're going to target one of those key states, accredited investor in Texas has a different culture and mindset than an accredited investor in California. So depending on California, there's accredited investors. I think the highest concentration would probably be in LA and Palo Alto. Those two are also different cultures, because there's a lot of millennials that are millionaires that are in Palo Alto, but it's different from LA, which is probably a lot of entertainment people. Then you go to Texas. Well, Texas is probably a lot of well-heeled generational wealth based in energy. So if you're going to be speaking to an accredited investor, the number one thing that I say is that instead of speaking your language, you've got to speak their language and bridge the gap. So one of the things that I was a specialist at is explaining syndicated deals in real estate in the language of my prospects. So one of my key prospects is essentially Wall Street lawyers. So we have Bay Street lawyers, but Wall Street lawyers. And what I do is I explain complex financial products using legal terms. Like for instance, when we set out the first meeting I have, we do financial discovery. So I use the keyword discoveries. That's a keyword that they understand. That's a legal term, right? So the same thing, if I was going to target somebody, pick your avatar, pick your ideal client or investor client. Do I want to raise capital from people from Texas because I'm in Texas, or do I want to raise capital from California because I'm closer to California? And then start speaking their language, start speaking their lingo in a way that they can understand, so they would accept you, and then start to explain complex financial and syndicated deals in that perspective. So the number one thing I teach in sales is it's mostly about empathy and emotional intelligence. And that's why this is a all-consuming activity, that because you can never get good enough at emotional intelligence. You can always improve. It's just like pro sports. You can always run faster. You can always run down the football field faster. You can always sprint faster. You can always throw faster. It's just like, if you want to be at the high levels of high performance, you just got to be fully immersed into it.
Yeah, I like that. I really keyed in on, speak somebody else's language. I gave an example up front that lost a lot of people. As soon as started talking, machine gun employment, I had a couple of eyes light
Yeah.
up and a couple of eyes. I mean, people just completely lose it there. But, um, so one thing that I demonstrated that I was good at is speaking the language of fellow military guys. But, I really appreciate that. You get to know where your people are coming from, what they think like, and be able to explain it to them in terms that they're going to understand. I think that's absolutely key on that one. So yeah, and then emotional intelligence. That's something that I'm just bad at. I'll be honest with you. I'm trying to get better, but it's one of those things that um, anyway, I won't go into my own shortcomings here with everybody else online. But all right, so we broke it up into tranches, and it's something that I haven't really thought of a whole lot lately. But there's a difference between the $1 to $2 million net worth guy, and there is the $10 million and a plus net worth guy, especially with who you're talking to as well, and how you can get to them. But yes, Angel, I know it can be learned. Thanks. I'm just slow, but. So I want to get to one of Mauricio's questions really quickly, and it's that there's often a discussion on chicken versus egg scenario, and this isn't quite the same chicken deal versus money. That's the chicken versus egg scenario that I see a lot. Is do you go for the money first or do you go for the deal first? So he's saying, let's see. So you have 506Bs and you have 506Cs. And if you have a lot of friends and family who can help you get a 506B along, would it be better just to get your first deal doing a 506B and then move into 506Cs, or go straight to the 506Cs? What are your thoughts on that?
For me, I would, once again, if I had to redo it all over again, I would start day one 506C.
Mm-hmm.
And of course, I'm completely biased because I've always been client facing. I've been able to raise capital on a 506C where we didn't even have a deal. We didn't have an asset that we were going to invest in. And the way that we would do it is how you talk to your investor. So a lot of the investors, and one of the things I was talking to some other folks, they were saying that, well, I haven't done a syndicated deal yet. It's my first deal. I don't have a track record. It's a bit of a catch 22 or chicken and the egg, where people say, well, once you've got some experience, then we'll invest with you, or accredited investors will invest with you. And so that's why you want to do a B, and you get some credibility. Well, one of the things I explain to people is that as a combat medic, when somebody's injured on the field and you're the only medic on the field, and you run up and you've got all the aid equipment, they don't really stop and ask for your credentials. They had so much pain, or they're in so much worry and concern, that they're just glad to see you. So same thing can happen in a accredited investor space. Once again, to debunk the accredited investor space, one of the things is that don't look at them as some kind of special unicorn. And I did this for over 10 years, and I have yet to come across an accredited investor. And keep in mind, I manage money for people 10 million plus, and I've yet to come across an accredited investor that's self-identified as wealthy. They all said, you know what, Ed, you've probably seen people with more money, but would you handle my account? We only have 10 million, right? And they're like kind of sheepish talking to me, right? And I said, well, you know what, Mr. Jones, for sure. Normally I don't deal with $10 million accounts, but I'll take you on, right? It's like, yeah, I bet you're dealing with mostly $50 million people. We're not like them. We're humble people. We only have 10 million. It's like, okay, well, you know what? Today, because I feel good, or because I feel nice, I'll take your money. Right. So that's what the space looks like. It's not some magical people like where they got monocles and they're like the Monopoly guys. Like, oh yeah, we got more money than we like. No, they're just they have as much imposter syndrome as everybody else. So I come in there and I would say that, well, if you're going to start off, it's just make sure you know where you're going to go. Because if you're going to end up with a $5 million accredited investor, you're probably going to spend more time talking to his accountant than you will him or her, right? So when you talk to a accredited investor, you're just trying to get their sort of approval, and eventually they'll say, you know what, I kind of, this stuff is a little over me. I don't really deal with this. I kind of run my own company, so I kind of focus on that. But it sounds good. Can you talk to my accountant, or can you talk to my tax lawyer to make sure that it fits into my portfolio? And then you're spending more time talking to the accountant. So that's why I say when you get up to that level, now you got to be able to speak accounting speak. So when I talk to the accountant, a lot of people would ask me, it's like, Ed, are you a CA or a CPA? It's like, you sound like an accountant. It's like, well, because I spent so much time with accountants, I know their language as well. I can switch to that gear. But that takes 10 years to learn to get to that. That's why I say start with the newly accrediteds, because now look at their pain points. So if you can highlight their pain points, then people will come out and you'll start attracting them, and they could care less whether you've done a deal or not. So I'll give you an example. If I were sitting around at a party or a networking event, I might throw out, for an example, it's like, well, what do you do, Ed? It's like, well, I do syndicated real estate deals. For instance, what I specialize in is helping people get out of their 1031s so they can get out of their real estate assets. So I 1031 into a Delaware statutory trust, and I handle DSTs just so that investors can stay in real estate without having to manage it. And if somebody glazes over and is like, I have no idea what a 1031 is, or I have no idea what, that's interesting, and then they try to excuse themselves to go to the punch bowl, then fine. That person's probably not accredited, probably not bought into real estate. If that person perks up and then, you'll see somebody at the side of the table, their head will twist, and then they'll start moving over, right? And it starts drawing in those people. It's like, what did you say about 1031s? If somebody knows about a 1031, it immediately tells me you've been in real estate. Chances are you've been thinking about a 1031, meaning you want to get out of your real estate deal. So I don't have to sell you on why real estate. And you're already on the cusp of a syndicated deal because you've tried it and you've recognized it's more work than you wanted because you're a lawyer, you're a doctor, and you don't want a second job. So now you want to get out, but you don't want to pay tax. So you've been taught about tax by your accountant. So now you're looking at a 1031, but you want somebody else to handle it for you. And then when I say a Delaware statutory trust, I can handle it for you. Boom. If somebody perks up when I say something like that, and then somebody looks at me and asks me a question to elaborate, I know that this person's probably accredited, or more likely to be accredited, more likely to have been in real estate and trying to get out of a real estate deal. That's a person I want to spend some time with.
Nice. So you drop some pieces of information and conversations trying to attract the right people, answering their pain points. I like that. What are some of the standard pain points that you see? I mean, you mentioned one, the 1031s and whatnot. What are some of the other pain points that you see with that newly accredited, that $1 to $2.5 million tranche of people?
Typically in a newly accredited, what they're starting to realize, they have two major pain points. What they're starting to realize is that they're paying a lot in tax, in income tax. So combined state and federal, they're probably getting into like the 40 to 43%. I think 43% is if you're like $500,000 or above, right? So if you start getting into six figures, like 200 to 300,000, those are the people I want to target anyway. So I start talking about the tax brackets at about 200, because 200, you need 200 in 2 consecutive years to be accredited. So whatever that tax bracket is, it's probably somewhere like 37 or 35, somewhere around there, right? So I said, well, every dollar that you make, well, most people are working for the government for at least everyone works for the government the first quarter. And then some people are working for the government all the way into like April or May before they start working for themselves. So that's a big problem. So I start talking a little bit about tax savings. So that's one. The second, as people are starting to become newly accredited, they're starting to have time is starting to become important to them. They maybe have kids, right? So they say, you know what, I don't have enough time for my kids. My G2 job is taking so much energy from me, and I really got to keep making income. So some of the discussions I would start talking about is tax savings and passive cash flow to replace the W-2. So if I start talking a little bit about those things, now those are starting to talk about things that somebody who's just starting to hit $1 million, or somebody who's starting to have multiple six-figure income for the last 2 or 3 years, those are things that they're starting to get concerned about. It's like, I'm starting to realize I'm paying more than tax than the average American makes. And like, that's starting to become a problem.
Yeah, I agree. Now, just if you guys don't know, you need to understand the tax benefits of real estate so that when you start getting to those pain points, you can start talking directly with them and just go through some of the issues of the ways that they can actually save money on their taxes. And incidentally, one of our investors came to me 2 weeks ago now, and he was happy that he got his tax bill down to $60,000 a year. All right. And he's like, man, all the depreciation that I was able to get out of the investments, out of the several K1s that you guys sent me, I was able to get my tax bill down to $60,000, And I'm scratching my head. I haven't paid $60,000 in federal tax ever, my entire life. But, so that's definitely one of the pain points that a lot of people are looking at. And, it's something that real estate and multifamily and syndications can absolutely answer. So you talked about some of the pain points: taxes, time, and then the 1031, getting that moved over. Let's see, looking at the time, we probably got five or 8 minutes left. So let's see. What's a couple of questions that popped up is talking with the financial advisors. What do you recommend saying to financial advisors, or how do you get the financial advisors, if that's the guy you end up talking to, when you're dealing with the higher net worth investors, how do you convince the financial advisors?
Right. So a quick point, just to cover off what you just said, somebody that you drove their income down to 60,000, you got to bank that benefit, right? So when I explain to people, it's like, well, where was your income before? Without our depreciation, where would you have been? And if they were at 200,000, if you drove his income from 200,000 to 60, then bank how much you had saved X amount in tax. And there's a mantra that I used to use: is every dollar saved is a dollar earned. And that's why I like tax management, is because when I save a dollar, it's as if I earned it for you. So I want to take credit for it. So I didn't have to put you into the stock market. I didn't have to put you in DGIA, didn't have to put you in risky assets. Just from tax structure alone, I saved you $100,000. I saved you $60,000 that you didn't cut a check to the government, right? That 60,000 is in your pocket right now. I'm taking credit for that. Right? And you gave me a $60,000 check. You gave me a $120,000 check. I gave you a $60,000 check back, or you didn't have to write one. Well, that's a 50% gain right there. Congratulations. It's like, I help you do that. And that's taking credit for those things that you're doing. Make sure that they register that makes something, because you want to change their thinking. That's one. So that's their pain point when it comes to accredited investor, is that how do I save on tax, and how you teach them a better way to invest. I'm not saying that you should replace capital gains, but tax management should be a big component of it. So I explain to people, it's just like if you have a patient on a table and it's bleeding out, you don't just keep pumping blood into it. Pumping blood into it would be trying to go after capital gains. But if I was able to pump blood into a patient, but also stop the bleed, which is the tax side of things, well, now as a net gain, you're doing better. But take credit for stopping the bleed, which is the tax side of things. So that's sort of one element of it. And I think that's taking credit for what you're doing and addressing that pain point, or highlighting that pain point. When you talk to an investment advisor, there's another pain point. You got to speak to that person's pain point. So initially, as a default, their guard will go up, because you're saying that, hey, you invest in my deal, it's $100,000. It's like, great, I'm fully invested, everything, all my assets are deployed. Talk to my investment advisor, tell him to liquidate 100,000 or something and give it to you. That's dropping out of his assets under admin. And that means that he's losing fees or commissions. And he's not going to let that $100,000 go easily. So you've got to give him enough of a benefit that he sees more of a benefit than the loss of commission. So one of the things I explain to it, if I'm up against an investment advisor, is like, hey, I realize I'm taking $100,000 off of your AUM, but here's how it's going to help you. It's because what I do is I do tax management. That's one. And I have something that complements all the capital gains that you're doing, because I have steady cash flow. I'm steady cash flow. I have income bearing investments. So because I have the stability here, it's going to give you a lot more flexibility to put them into riskier assets. So it's like most accredited investors, like before you get to accredited investor, you stick with your default asset allocation. People have stocks, bonds, and then cash and cash equivalents. As you start to get to $1 million portfolio and above, now you get into structured products and real estate. You start adding that area. So for me, as a stockbroker or as an investment advisor, I wouldn't add that until somebody broke over the $1 million range. If you're under $1 million, I would just stick to sort of like basic asset classes. But then as you get larger and larger, now I got to take a look at structured products. Then I can take a look at real estate, syndicated deals, debt deals, all these other different types of assets. So I explained, well, instead of getting into your private placement, sure, I'm going to take 100 grand out of your AUM or in management, but at the same time, I'm giving a little bit of stability here in your overall portfolio, and it's providing the tax management side of things. And I'm not a Series 6 or Series 7 guy. I can't take the rest of the assets. I'm just taking this little sliver, and I don't believe that it should be more than say 10 or 20% out of somebody's portfolio. I'm never going to go beyond that. So they might be happy with it, because now you're providing the tax element of things that maybe they're beating up that investment advisor about.
Yeah, absolutely. Stick to the pain point. And I've had a hard time when investors say, talk to your financial advisor, because, there's one thing you always have to look at what the incentives are, and I think Edmund just hit the nail on the head. If you're taking that $100,000 away from the financial advisor, I mean, his incentive is going to be to clamp on that because he's charging, an annual fee on the amount of money that he has invested. So you've got to be able to get around that pain point and make that case. And I like how you put that, basically tell them, hey, I'm going to give you more flexibility to do what you can with this money because I'm providing the stability, and you can go for the more risky products. You can go for the higher gains and potentially just earn more fees anyway. So I like how you put that in. So, all right. Looking at the time, 10 minutes left. I want to open up for Q&A. So let's just do this at final advice, as far as, getting the ball rolling and, starting to find those accredited investors. What would you say to somebody who's brand new to the game and, first couple of steps on getting that ball really rolling and automating it?
Yeah, when I work with people, when I coach them, it's going through some of the steps that I already talked about, which is trying to figure out what your investor avatar is. So what kind of accredited you're going to go after. After that, then you come into what value do I provide for that person? So when that person sees me, when I walk in the room, what do they think of me? And what am I going to say? So what's my unique value proposition, or what's my unique selling point? And which is the why me out of all the other syndicators? And then learn your craft. So learn what you can provide, understand your target market and how they think, and talk to their pain points, and learn emotional intelligence, which is a lifelong study. Like being a salesperson or being client facing is a lifelong journey. And that's why it's like, figure out whether your strength is in asset management or whether it's client facing. And if it's client facing, turn it into a lifelong vocation and be fully committed to it.
Yeah, nice. I very much appreciate that. And that's something that I've recognized that I have to work on, I'm the dad that told, his little girls to, here's a straw, suck it up, not a lot of emotional intelligence there, but my older daughters have heard that a lot, and I'm trying to do better, promise. But anyway, well, hey, let's turn this over to the group. If you have any questions, you can use the, raise your hand feature, or drop it in the chat, and, we'll get to it. Any questions right now? All right, Oliver, go ahead and take yourself off mute and hit us up.
Okay, Edmund, how are you, sir? First of all, thanks
Good.
for coming on today.
Yeah.
Fantastic, man. I appreciate that. It's glad you got the opportunity to come on. Thank you, Brian, for putting this on. I spend a lot of time on social media and on IG, LinkedIn, things of that nature. How are you kind of putting your message out there and letting the investors come to you as opposed to you having to do a lot of the hunting? Basically, I look at the trap aspect of it, putting the stuff out there and letting them come to you at the same time as you're doing the groundwork, if you will. But I wanted to see what kind of action you're taking online.
Right. And it goes back into what I first started off is what kind of accredited investor are you going after, or what kind of investor are you going after? And then once you figure out who they are, then figure out where do they hang out. And my question is, do those accredited investors hang out on social media a lot, right? So if you're talking about a baby boomer accredited in Texas, I don't think they're spending a lot of time on Snapchat, right? So it's most baby boomers probably don't even know what Snapchat is, right? So you got to look somewhere else. But I understand what you're saying is, how do you create a passive income stream, or how do you keep passive your funnel, your sales funnel passive instead of you trying to pull? Well, to start off, you're going to have to pull. Now, the way that you create, depending on what kind of accredited investor you're going after, if it's the baby boomers, the way you get to a baby boomer accredited investor is through other financial professionals, which is lawyers and accountants, mostly their tax accountant. So what I would do is, and we call them centers of influence, or COIs. So I would generate a lot of deep relationships with COIs and look at their pain points, right? So an accountant's pain point is they're always being beat up on not being able to manage somebody's taxes. So every time they fill out somebody's taxes for an accredited investor, they say, "Oh, I'm sorry, Mr. Jones, you're going to have to pay $400,000 in tax." And they're like, "What the hell? Can't you do anything?" And it's like, and they get pissed off at them, right? So if you come in and have a solution, is, hey, instead of that guy writing a $400,000 check, I can show you how he can write a $300,000 check. If you help him and introduce him to me, I will put him into my syndicated deal. I'll give him some write-offs and he can drop 100 grand. It'll make you look good. So it's incentivizing the accountant to refer that client to you, right? So ask yourself, if I'm going to be a lot on social media, who am I broadcasting to? if for me, I don't really like social media in that way, because you're broadcasting to a really big audience that wants to learn about investment, but probably doesn't have very much money. So you're going to spend a lot of time explaining why real estate to a whole bunch of people that are not qualified. Well, that's going to pull you down into the mud and get you stuck there, which is wasting your time. Because the more time you waste over there, the more time you're going to miss the accredited investor that does want to invest with you. So try to find a room where you can focus exclusively in on accredited investors, speak language that only accredited investors understand or want to talk about, and everybody else glazes over. That's what I want to do.
Got it. Awesome. Thank you, Evan.
All right, good enough. All right, other questions? Either hit the raise your hand function, or let's see, did I miss any in the chat? I'll screw this.
I got a quick question for you, Edmund.
All right, hit it.
You were in the early 2000s, Dallas, Texas. What about now? Any other markets that you're hot on right now?
Good question.
Specifically in apartments?
I've been out of the game. Yeah, I've been out of the game for quite a while. So I'm not too up to speed on where cap rates are and what values are like. I do know that a lot of people are looking at different areas. So I've been hearing Texas is a big one. I've been hearing things like Oklahoma, places like, and I've been hearing places like somebody's trying to do deals in Chicago, but Chicago is brutal. They said like cap rates even differ depending on what side of the street you're on. Some of them like 15, it's like nuts, right? So me and my preference is a lot of the sunshine states, right? So Texas and Arizona were my specialties. I like them because the construction is relatively cheap. Once you start to get to the colder climates, the property has to be a lot more robust. You have to worry about ice freezing and the constant freeze and the thaw. If you stick to Texas, it's kind of like one climate for most. So it's easier construction, cheaper construction.
That's a good point. And I think a couple months ago with that big ice storm that hit basically the whole state of Texas, we found that out. A Minnesota built house or a Salt Lake City built house would have done just fine in Texas during that ice storm. Yeah. But that's something I actually hadn't realized before. I mean, I think in the back of my head, I mustn't realize it was true, but that's a good point. There's probably a little less, less exposure to very, very harsh temperatures. So easier to construct. All right. And Angel just hopped on and said, our Texas homes are not built for that. All right. So we got a question from Matt. Have you ever dealt in a tax deed investment strategy as part of syndication deals? Any insights if you have?
So I'm not too familiar with that term as tax deed. If you could elaborate a little bit more on what that is. It might be a Canadian term for it.
Matt, unmute yourself and hop on.
Yeah. So can you hear me?
I can hear you.
Yep. Okay. Yeah. So tax deeds are essentially when properties have essentially gone into property tax default. They have a lien on top of them, and essentially the municipality is going to sell off the property for the owed amounts. And when you purchase them, the municipality takes the income from that, and you essentially, through the process of foreclosure over X amount of time, you then gain ownership of the property, and you can either then use it for rental, or you can flip it. You can, hold it as a long-term investment, whatever you want to do. But it's essentially a tax default situation where you acquire the property via that mechanism.
Yeah. So once again, just to sort of full disclosure here, I'm not the best asset manager, and we had dealt with, but I do have working knowledge of it. We did have some deals where we were looking at foreclosures. We recognize there was a couple of problems with foreclosures, and when you do when you start to have government assistance and things, it starts to become problematic because there's a lot of rules you got to follow, and you can get stuck into things like maybe you can't. There's a certain amount of capital improvements, like a DST, for an example. There's certain capital improvements that you can't do, right? So you're kind of stuck. So the more regulations you have, the more challenging and problematic it becomes, because you don't want to go outside the lines, and when you do, you tend to get into some kind of penalty. So the preference for me would be things that you buy sort of free and clear. You want to buy depressed assets, ones that you can force appreciate. But once you start getting into foreclosures, there can be some challenges. Like for me, we were looking at a lot of Phoenix deals after 2008, 2009. And we're recognizing what these foreclosure deals are terrible, because once the bank owns them, they go into the place, they turn off all the HVAC, they shut the whole place down, they button it up, and then it sits there for about a year. And the whole thing is just covered with mold that you can't recover. And we recognize, it's a good thing that we didn't buy these foreclosure properties, because we would have had to gut the whole thing, right? So you just got to be careful with those types of things. And I don't know enough about it where I could suggest to you whether you should go into that type of deal or not. My tendency with wanting to stay away from things with more regulation and stay with things that are more open and free of what you can do with it.
Yeah, that was good. Now, I do have one question as well for you, because I kind of filed this way in the back of my head when you first said it. So when you started in this business, it was, pre 2008, before, the collapse of the real estate market. What advice would you give people? I mean, having lived through that and gone through that, what advice would you give everybody right now to make sure that you could weather a potential storm like that?
One other thing is be selective on your investors.
Mm-hmm.
And there's a lot of cues you can, the more time you spend with investors and accredited investor, the more you'll start to realize which ones are going to turn on you. So when I went through 2008, I made those phone calls, and I got to tell you, my top two worst ones were literally death threats, right? And I learned from 2008 to recognize I can spot that kind of individual before they happen. Everything's hunky-dory when you're signing checks and everybody thinks that you're going to have a great deal. But ask yourself, if this deal went sideways, this person's writing me a $50,000 or $100,000 check. If I had to make a phone call and tell them I lost it all, what do you think that person's going to do? And if you think that that person's going to throw a telephone book at you or do something that's incredibly, that's going to be, they won't be able to handle it well, then be cautious about raising that kind of capital. That's one. The second thing I would look at is when we raise a deal, we want to look at the quality of your deal. So say you go in and say, well, we're going to raise $10 million. Or you said, I raised $10 million. As another syndicator, what my first question will be is, if you raise $10 million, I want to ask how many people you raised it from. Did you raise it from 10 people, or did you raise it from 5,000 people? Because I don't want to syndicate a deal where it's 5,000 people raising 10 million. That's way too much in investor relationship, right? That costs way too much money. Mm-hmm. If you raise it from 10 people, now that I can handle, right? I can talk to 10 people and go and raise that, because that deal gets done fast, right? And a lot of the times, what you're doing in a $10 million deal with 10 people is that there's one key investor that you just update, and that key investor is sort of endorsing you and the other ones are following along, which goes into sort of like the next step is, as you get bigger as a syndicator, is have a board of directors that people respect. So you'd have key investors that are your board of directors. That's another way to get over a lack of experience. So if you said that, like today, if I said that, you know what, I haven't done a single syndicated deal, I know how it all works and I can talk about it and I can talk about tax and all these types of things. Oh, by the way, Jeff Bezos is on my board of directors, one of our lead investors. Boom, that check is probably written, right? So you borrow off of their experience and their credibility. Now, Jeff Bezos is just because everybody understands, but if you pick an investor, a real estate investor that everybody trusts in your prospecting, that goes into knowing your crowd, figure out an investor that they would trust, and you say that, oh, by the way, he's on our board of directors, I have corporate governance, I report to him, and he goes through all the pro formas, and he's endorsed it, he's written a check. Then you can raise your other capital. So you can lean off of other people's experience.
Nice. I like that. I like the board of directors idea too. I have noticed, we've got a couple of the higher net worth investors, and they either all invest or they all don't, is how it works. If one person decides to put his money in, he's got 3 or 4 friends that also come in every time. So, and I like that you bring up that point, the board of directors, if I could get Jeff Bezos on my board of directors, he'd be there tomorrow. But it's a good point. And a lot of people talk about borrowing credibility of mentors or more experienced people, but you've kind of put that at a different angle that I've never considered before. Borrow the credibility of some of your investors, because, a lot of these people have a lot of credibility in their fields. Maybe they've, made their millions in a business, or maybe investing, but, they've got a certain amount of people that are going to look at them as, hey, if he's putting his money in there, I probably should follow suit, if that makes sense. But anyway, we're about the hour mark. Any concluding comments, Edmund?
Well, just to follow up on that point, Brian, like if somebody said, if you recognize or you identify a lead investor that has a couple of people following that person, then make that offer to them and say, hey, Mr. Johns, if you're going to come in, I recognize you're probably going to loop in 3 or 4 others. If you do that, I would love to invite you to sit on my board. That way you have a higher level of scrutiny over me, and I will show you everything. I'm an open book. And it entices that person to come in. It gives that person, so one of the other pain points for an accredited investor at that level is probably a $5 million person, is notoriety. So they want to go around and say, oh yeah, I sit on the board of this company, I sit on the board of this charity, I sit on the board of that charity. And you give them that next level of what they're looking for. I say, well, I'd love to have you on my board of directors. I believe in corporate governance. You can take a look at everything, because you're asking people to, people are looking for you. And when they endorse it, I'd love to make sure that you fully understand what you're endorsing. So I'd love to invite you into my board of directors.
I love
And
that
boom.
idea.
Now
We gave him
now the wheel is starting to turn.
Yeah, we gave him GP percentage in addition to his LP dollars, and I think the corporate the board is next level up on that one. So definitely, hey, thanks a lot. I learned a ton. Appreciate your time, and even coming in from Toronto, Canada, where you have no cell service, which I don't know how you do that. I mean, that sounds terrible, but anyway, thanks so much. If there's ever anything I can do for you, actually, I do want you, I know you are also doing a little bit of coaching on the side. So how about this? What I'll do for you is I'll give you a chance to tell us what you do as far as your coaching, and give you a chance to pitch that.
Yeah, so I just put my LinkedIn profile there, or my URL or my connection. So feel free to connect with me. So what I do today is I'm a sales and business coach. So I'm a performance coach for professionals. And just recently meeting Brian, I realized, what, I have all the skill set that is specific to financial services and 506C, that it's kind of sitting in a war chest collecting dust. And a lot of it's applicable in other things. Like I help a lot of entrepreneurs, but in this particular crowd, I can dust off the entire box and show